understand the economy, you have to understand human nature.
This podcast is powered by Acast.
How are you doing? I hope life is all going according to plan. We are here in the basement. We are having a little chat about all sorts of things. It is time for the podcast. This podcast is going to be on the economics of climate change. It's a huge, huge idea. But John has a bee in his bonnet about posters.
I do. I absolutely do.
And I'm not going to stay quiet about it.
No, but I don't know. I walking around town and walking around this area, and the place is awash with election posters.
Yes.
And every lamppost and every spare piece of signage that where you can put signage.
Signage real estate.
Signage real estate.
Exactly.
But the thing about the posters is, so I'm looking at, these are for obviously the
European election and the local elections.
And local elections. There are pictures of fellas and girls looking down at me. And they're very much young fellas and young girls looking down at me. I haven't a clue who most of them are.
Yeah.
And they're also really young.
John,
there's two fellas in particular that are just so young. Yeah, and I know they do say that, you know, the sign of getting old
is when the cops look young.
The cops look young. But the politicians.
Yeah.
And then you have to ask. So I'm going, okay, that's fine. Okay, maybe I am moving on in years a little bit. And maybe, you know.
Bad back, the bad knee.
All of that kind of stuff. But the problem is that you begin to wonder, what do these fellas actually know about the world? They're just out of college.
Yeah, well, it's a very interesting point. I just had a conversation with a French friend of mine.
Yeah.
Who was making the point that the new French prime minister is 35 years old.
Right.
And his name is Gabriel Attal. He's never had a job. He's always been an advisor to Macron and a policy sort of wonk in the background.
Right.
And this guy made the point to me is, we are not a serious country anymore. And what he was saying was that when you elect a technocrat or a functionary and you elevate them to that level of seniority, as in the person who runs the government, without any or very little experience, probably emotional experience, probably popular experience, what you're doing is you are, in this man's eyes, you are not serious. You know, that you don't have the requisite reservoir of deep, not just experiences, but relationships, networks, understanding, comprehension, all that sort of thing that goes with this catch-all umbrella term called maturity that is necessary to run a country. So a country like France, where, for example, there's so many, de Gaulle was the greatest expression. He said, how can you possibly keep a country together like France? And people said, why? He said, because we have 136 different cheeses alone, which I thought was amazing.
That's good.
It's a great one, isn't it? Right.
But do you know what? In fairness, on the flip side, what I do find really encouraging about all those people that are going for office, whether it's local or European or whatever it is that they're all engaged
and
in politics and enthusiastic. And that's really important.
You need generational change. We're sitting here as two middle-aged men, and it brings to mind the great expression that Tony Benn said to me, where the British politician, a veteran, we're about to become veteran podcasters, John, so just watch it. We're going to describe as veteran podcasters, you know, it's all over, right? And Tony Benn said to me that what do the young and the old have in common? They're bullied by the middle-aged. Right? You know, so it's the same idea. So it is good. But what also fascinates me is the way in which the backdrop to the elections has changed completely. So in the last European election, there was a massive European-wide swing to the Greens.
Yeah, the green wave.
Yeah, animated by climate change.
Yeah.
And I have a hunch that climate change and the Greens only do well when people have nothing else to talk about.
Yeah, that's a bit cynical, but yeah.
But it's the last election, you know, Europe was at peace. The economies were fine. We were dealing with this sort of post-transition from the financial crisis. Unemployment was falling. Budget deficits were fine. Immigration wasn't a massive, massive thing. Putin was well behaved. The Middle East was not in flames. And that gives the space for people to contemplate the very long term. And
Yep.
the very long term is the climate change crisis. But it's a long-term idea.
Yeah.
It reminds me, I've always told you, it's a bit like Glenroe.
Glenroe?
Okay, so Glenroe, you know the music, do you remember the theme of Glenroe?
Yes.
That used to terrify me because it was on at 8 o'clock on a Sunday night. And
Yeah.
it always triggered that I hadn't done my homework. And the climate change thing strikes me as the same thing. So procrastination is a deep human instinct.
Yeah.
Which is, and you know this from homework.
Yeah.
You get all your homework on a Friday afternoon and you do it all on Sunday night.
Yeah.
Right? And you say to yourself, oh, I'll do a little bit on Friday. I'll get up Saturday morning. I'll write that essay on geography.
I never said that, by the way.
That's true, actually. Swatty pants here, dude. Swatty pants, sweat,
Yes.
right? But same idea. Climate change is so far away from most people. Something in the future that the urgency is rarely urgent, in effect, right?
Yeah.
So when things are going well, we can talk about climate change. Now, for example, in this election, issues are going to be immigration. Issues are going to be economic security. There will be cost of living. There's going to be war in Europe. There's going to be nationalism in Europe. So all that green, lovely stuff is put in the back burner. And I think what you'll see in this election is the Greens will get hammered. And I mean, I'm talking in Europe, not just in
Yeah.
Ireland, all over. And issues of nationalism and what Martin Luther King used to call the extreme urgency of now. What
Yes.
is the now?
Yeah. Yeah.
And the now is not the climate. Well, it should be, but it's not. But we're going to talk about this and the economics of climate change with our next guest, who is Brett Christophers, who's written 2 fascinating books. The latest one is called The Price is Wrong, Why Capitalism Cannot Save the Planet. He is in Uppsala in Sweden. So let's go and talk to Brett Christophers. We're now going to go to a very fascinating part of the world. It is a place called Uppsala, which is one of the oldest universities, maybe even the oldest university in Sweden, one of the centers of learning in Scandinavia for many, many hundreds of years. And we're going to talk to Brett Christophers. Now, that name might mean something to you. First of all, he is a friend of the show, which is always a friend of the great Mark Blythe, right? Which is Brett. Brett, how are you? Great to see you.
Yeah, it's great to see you too. And thanks for having me.
So, Brett, I first came across you. You wrote a book, I think about 2.5, maybe 3 years ago. It was published, and it kind of scratched a niche that people were itching, which was how come portfolio managers and asset managers seem to own the world?
Yeah.
How did you come up with this idea, first of all? And then we'll talk about the latest book on climate change, which is the more pressing issue, maybe.
Yeah, so you're right. And I think particularly, although not only, but certainly in Ireland, the question of portfolio asset managers is one that's very topical, not least in relation to housing. I mean, I think the reason that book came about and the reason I wrote it was that I've been doing a lot of thinking and research around questions of housing, questions of infrastructure, particularly infrastructure for the delivery of day-to-day services, water, telecommunications, transportation, energy, and so on. And I kept coming across the same names over and over again, which were the Blackstones and the Macquaries and the BlackRock and the Brookfields and the KKRs. And I was like, well, what's going on here? And so it became rapidly clear that increasingly it's the case that lots of the kind of big physical stuff through which we live our lives, those types of infrastructure, housing of various different kinds, is owned by these kind of esoteric financial investment institutions that people don't really know much about. So the book was really just kind of a little bit of an expose, really. It was trying to bring it to people's attention. Look, these guys are really important. This is how they operate. And this is why it matters to people that this kind of stuff is owned by this type of financial investment institution. So that's what that book was about.
Well, I mean, it really struck a chord here because, again, what happened after 2008, the Irish state ran out of money. The Irish banking system went bust. That source of financing disappeared, which should have been only temporarily. It should have been like a 2 or 3 year period where everyone retrenches and there's no money. And yes, of course, if there's capital around, international capital, you bring it in and it helps you get over the hump. But what has happened since then in Ireland is that these guys are a permanent fixture in the ownership of Irish infrastructure. And that is something that I think a lot of people are just asking questions about are they appropriate owners? If they aren't appropriate owners, why do they own it? Is it right that a large, let's say, apartment block is owned by a private equity fund, and the private equity fund is in the business of squeezing the asset, but the asset's your feckin' house?
Exactly. Yeah. And I was in Ireland recently, and there was lots of interest in this question, and I don't think it's surprising at all. But it's not just Ireland. And I think that, if I wanted to summarize it, the bigger picture in one sentence, I'd say they are a permanent fixture now. And they are a permanent fixture, I think, for two reasons. So one is that on the one hand, you have governments who historically were in the business of developing, owning, and operating lots of these types of assets through public sector enterprises of various kinds. For all sorts of different reasons, they have been persuaded or have persuaded themselves that they no longer should be in that business. They should be fiscally conservative. They shouldn't be owning and developing and financing these assets. Well, if governments are not going to do it, then the private sector is where governments are looking to do it. So that's one thing. The other thing, if you look in the private sector around the world and you look at who has command over the biggest share of kind of surplus capital that is available for investment, well, it's asset managers. And so you put those two things together, then it's more or less inevitable that they are playing and they will continue to play a really, really big role in this space.
Yeah, no, and I know it's something that I think it makes people feel very, very uneasy. And for a reason best probably linked to the link between democracy and government, there is a certain amount of accountability in a state. And there's a sense that these guys are offshore and they're private, and they're very, very wealthy, and they're driven by spreadsheets. And frankly, they're hoovering up all these assets that should be made available to the average person, particularly in the Irish case when we talk about private housing. But we can discuss that another thing. It's just, this is when I first came across the name. And then, of course, Mark said, you got to talk to Brett. And now you have, it's in a similar vein, a new book out, which is called The Price is Wrong. So we all know the price is right. And it's The Price is Wrong, Why Capitalism Will Not Save the Planet. So explain this to me, because again, over the last 5 years, particularly since COVID, interest rates dropped to zero. There was the whole Green New Deal, there's green investment. And the idea is that the private sector, capitalism, will fix the environmental dilemma by renewing or increasing the amount of renewables in particular. Tell me why you think that's wrong.
Yeah. But the basic thesis is this, the basic argument of the book is this, which is that the business of renewables deployment, by which I mean developing the wind and solar farms, owning and operating them and selling the electricity that they generate, that business is not a particularly attractive one in terms of the key metrics in terms of profitability and returns on investment. It tends to be not a particularly attractive business for all sorts of interesting reasons. And the second part of this thesis is, well, that's a problem. And it's a problem, A, because the world is basically relying on electrification in general and solar and wind in particular to drive us away from our reliance on fossil fuels. And B, it's a problem because the world is predominantly relying on the private sector to do that. So there are exceptions, of which China is the most important example, where most of this is in the hands of state-owned enterprises. But elsewhere, what governments are basically doing is turning to the private sector and saying, we are expecting you to do this. We will design and regulate electricity markets. We will provide various forms of subsidy and other support mechanisms to kind of nudge you in the right direction when you're not showing that you're willing enough to do it yourselves. But basically, it's in the hands of the private sector. And obviously, the private sector is dictated by the profit motive. And so if the profit requirements, the profit expectations are not there, then inevitably the investment that we need is not going to happen. And my argument is that's exactly what is happening. And that's why, yes, renewables are growing, but critically, they are not growing fast enough to displace growth in fossil fuel electricity generation, which is still growing. So that renewables growth is supplemental to, rather than substitutive of, electricity generation from fossil fuels. So that's the basic argument.
Brett,
that's the thesis.
Can you explain something to me? Because here in Ireland, it feels for at least 3/4 of the year that we are being blown off the face of the earth, right? We have these massive winds coming in from the Atlantic. You know, it's an occupational hazard. We have the Gulf Stream. We have global warming, which is changing not only the wind pace and acceleration, but the direction. It feels like, you know, you look at Irish kids at bus stops and they look as if they're being blown away. So then we said, okay, isn't this amazing?
Yep.
Isn't this amazing? We might have stumbled across a source of very, very, very efficient renewable energy that we are exposed to all the time. Can you explain to me, is it the problem that the infrastructural spend is so enormous to harness this wind, and the price at which the electricity is being sold to the public is so low simply to shift people in terms of their consumption of energy? Is that why these are unattractive businesses? I don't understand why they're unattractive businesses first.
That's actually, you've done a much better job of getting close to the reality than most people I talk to about this have done.
Well, we'll take that as a compliment, John. A compliment coming from Sweden.
So you should. So you should. Because both of those things you've pointed to are very, very important. You know, first of all, the fact that this is a business that is very distinctive in terms of its kind of cost and revenue characteristics. Essentially, all the cost is upfront. You know, buying the land, buying the turbines, install, and once it's up and running, there are essentially no costs. If you've taken out some debt, which, as we will see, is very, very important to this business, then you have to, you know, make interest payments and so on. And occasionally, you have to send out an engineer if a turbine stops rotating to kind of put a screwdriver in it and get it turning again. But there's no fuel costs or anything like that. So all the costs are up front, all the revenues come later. So absolutely, that's important. And the point about the price is very, very important as well, partly because we are in a world where governments are desperately trying to facilitate and drive an energy transition without that incurring supplemental cost to consumers. So they have designed electricity markets, and they have typically designed the kind of support mechanisms that they provide for renewables deployment precisely in a way to try to keep prices down. And of course, in doing that, they are, by their very nature, constraining profitability in that business, which is not to say that's the only reasons why there are constraints on profitability. There are others, not least the fact that this is actually a very competitive sector, and competition, in all other things being equal, also tends to depress returns. You know, there's no OPEC in electricity generation to help kind of have a source of monopoly power or oligopoly power to keep profits up. But one of the other things that's very important about this, so the point I make in the book about profitability being a constraint, there are two other things that I want to put out there for you that are, well, three things that I think are very, very, very important for people to understand about this. First, the constraint, by which I mean the people that are worried about less than attractive profitability, are not necessarily the companies that are developing the renewable energy themselves. So when you look at this and when you do research in this area, what you find is there's actually loads and loads of companies out there in the renewable space who would actually proceed with the wind farm or the solar farm developments, even if it didn't look like it was going to be a business that was going to make them a lot of money. It might not make them any money at all. There's lots of people out there who want to just do good things for the world and would be quite happy to enter a business that didn't pay a lot, might be very, very risky. However, they are not able to raise the capital to do that under those conditions. And this is the key thing. So when you are developing a wind or solar farm, typically somewhere between 60 to 90% of that upfront cost will be financed with debt, with borrowing. And what that means is when you go to the bank and say, look, I want to get into this business, the bank will be the one that looks very, very closely at profitability forecast, electricity prices and all that sort of things. And they are the ones who say, well, hang on, this is actually not a great business. And I'm worried that if I give you 150 million euros or whatever it might be to develop the new wind farm, you're not going to be able to make your interest payments and you're not going to be able to pay back that debt on time because actually the profits that you require to do that are simply not there. So this is a key thing to understand. The decisions that are typically getting in the way of the developments happening are not the decisions of the energy developers themselves. They're the decisions of the bankers who are required to provide the finance for the development to happen. That's the first really important thing. Second important thing is that profits are always relative. Levels of return are always relative. What do I mean by that? What I mean is that whoever you are, if you're any kind of capitalist actor, you always have alternative investment opportunities available to you,
Yeah.
even if the alternative investment is simply putting the money in the bank or in any other line of business. It's not an absolute thing. Now, on average, over time, and it varies a lot, returns in the renewables deployment business are anywhere between kind of 5 and 8% as an internal rate of return. Now, 5 to 8% looked pretty good 4 or 5 years ago, maybe, when interest rates were zero. But today, when interest rates are 5 or 6%, and you can get 5, 6, 7% putting your money in the bank or in risk-free treasuries, for example, well, 5 to 8% for the risk of going through all the hassle of developing the business doesn't look so good either. The other thing is, it also doesn't look so good if you are a BP or a Shell or an Exxon who is used to getting minimum returns of 15% in your upstream oil and gas business. You know, lots of people are like, well, why aren't the BPs going into the renewables business? Well, because they're used to returns that are 3 times that level. And it makes no sense to them on a pure economic basis to swap a high return business for a low return business, as long as they continue to believe that those returns will be available in their traditional business. And that's obviously the key thing. If they thought that government or regulatory action in terms of things like carbon taxes was coming sometime soon that would depress those returns in upstream oil and gas, then of course they would think about switching. But I think everything of the last few years shows they don't believe that's happening, precisely because governments are giving every indication of that it's not going to happen. They're handing out new oil and gas licenses willy-nilly. So that's the second thing. It's all relative, and it has to be understood in that way. The third and final point is that the argument that the book makes about profitability is it's about 2 things. It's about both the level of returns that are available, and as I say, you know, somewhere 5 to 8% is a benchmark there. But it's also about volatility. And this is the really important, one of the really important things about electricity, which is that returns and revenues in the electricity business, but particularly in the renewables business, are very, very volatile over time. And that's because electricity prices are very, very, very volatile. So if you look at electricity prices in the markets into which renewable energy developers sell their electricity, I don't think there can be any commodity out there where you get such wild price swings at all time scales. You know, the price of electricity can be 50 euros per megawatt hour one day or 1 hour, and it can be 2,000 euros per megawatt hour literally an hour later or a day later.
And is this because the wind doesn't blow?
It's partly because of that, but more, I mean, this is getting a bit wonky, but it's also super interesting and important. It's more because of how electricity is priced in wholesale electricity markets. And during the electricity crisis, energy crisis, in 2021-22, lots of people might have heard the concept of the merit order. It was something that became in the news because people were like, well, why are electricity prices going up? But the basic idea, to cut a long story short, is that all electricity generators in a particular region will make bids as to how much electricity they can produce for a particular hour time slot into the market and what price they'll sell it at. And then the grid operator will accept all those bids that are required up to the point that it can match the expected demand during that period. So supply and demand have to match at any particular period in engineering terms. Now, the way it works is that it accepts all those bids in an escalating order of price, but then everyone gets paid the same amount. And that amount is the most expensive bid that had to be accepted to supply the demand. Now, if all your electricity generators, if the wind is really windy at a particular moment and they're all bidding, say, 30 euros per megawatt hour, then that's the market price. But let's say the wind stops blowing and that you need a gas generator to provide that last unit. And let's say also, because Russia has invaded Ukraine, that the gas price has gone from 20 to 2,000, then that will be the price of the electricity that everyone gets paid. So if the wind drops and suddenly a gas generator has to be fired up, the price can go from 20 euros per megawatt hour to 2,000 euros per megawatt hour because of the way electricity is priced. So it's incredibly volatile.
So all this feeds back into the first problem, which is the financier's willingness to take the risk.
Exactly.
Because what financiers hate is volatility. Traders love volatility, but financiers hate it.
You have taken the words right out of my mouth, because when the wind developers or the solar developers go to the bank and say, lend me that 150 million euros, they say, how long is it going to take you to pay it back? What price are you going to sell your electricity at? And you say, I have no idea, because electricity prices are very, very volatile. And the bank says, there's no way I'm lending you that money. And here's the kicker: unless you can show that there is a mechanism for you to stabilize the price at which you will sell your electricity for, say, the next 12 years, to enable you to give me the confidence that you can repay my debt. And here's the thing: there are therefore a range of different mechanisms that enable energy developers to stabilize their prices. One, and the most common historically, are so-called feed-in tariffs provided by governments or government-backed utilities, where the utility will say, we, whoever it might be, I don't know, Eon or someone, we will buy all your electricity, Mr. or Mrs. Wind Farm operator, for the next 12 years at a fixed price. And the wind farm operator then goes to the bank and says, look, we've got this promise, now give me the finance to develop it. Or, and this is something that lots of people will have heard about, I'm guessing, in recent years, someone like a Microsoft or a Google or an Amazon comes along and says, we're building a new data center for our AI business. It's going to take a shit ton of electricity. You don't have to sell your electricity in the market. Sell it directly to us. We'll take all your electricity, again, over the next 12-year period at a fixed price. And then the developer takes that agreement with Amazon, goes back to the bank and says, look, here's your confidence that you're going to be able to get your money back. So those forms of stabilization are absolutely critical to rendering renewable energy projects what's called bankable in the industry. They're almost essential in order for them to be able to raise finance.
So, Brett, we've taken the sort of the nitty-gritty of how the market works, how the financing works, or how it doesn't work. And let's pull back a wee bit, because the planet has made this massive bet on renewables. If you think about it, the game is we will reduce generating heat from burning stuff, generating energy, and what we'll do is we'll harness this blowy stuff rather than burny stuff. And what you're saying is the problem is the burny stuff still makes much more economic sense when left to its own devices than the blowy stuff. And as a consequence of that, or as a result of that, the planet will not be saved by renewables in this setup, in this system.
Yeah, and actually I think that's a very nice segue, that the last comment you made there, in this system, to how we might think about changing things in order to push things more quickly.
Great. Well, let's look at that.
Yeah, and what I mean by that is this, which is that if you assume that we will continue to need much more electricity generating capacity going forward, which most people do assume. And I say that if, because there are certainly lots of people that are out there, as I'm sure you know, who say, look, the answer is actually in large part on the demand side, by which we need to kind of reduce our consumption of everything, including electricity generation and travel, the kind of degrowth, post-growth argument, which says, look, we need to focus on the demand side. But if we leave that whole argument aside and say, look, let's assume that we do need this massive ongoing investment in renewables going forward. And let's assume that policymakers, having plumped for renewables instead of, say, nuclear, are right in having made that decision. How can that happen more quickly, which it definitely needs to do? There are three basic answers out there, I think, which is really important for people to be aware of. And not surprisingly, they are associated with different kind of constituencies, for want of a better word. The first constituency is what I would refer to as kind of mainstream economists, mainstream energy economists. So economists trained in orthodox economics who focus on the electricity sector or the energy sector. They say this. They say the problem is not that we are relying on markets and the private sector to do this for us. The problem is that we haven't got the market design right. So and I have a degree of sympathy with this argument, because, as they point out, the electricity markets that we have were designed for and implemented in a fossil fuel world. And they have not been updated and modified for the new energy mix that we are living with now. And so they say, all we need to do is kind of tweak the market design, change the way we price and buy and sell electricity, and then everything will fall into place. as I say, I'm sympathetic to that argument. I'm not convinced by it for a number of reasons. One is simply that that's always economists' answer. The answer is always market design. Get the, optimize market design.
Yeah, well, I always say, economists say, oh, well, the model doesn't work because the human at the center of the model is a problem, not the model itself, right? It's like learning Latin grammar rather than actually speaking the language. That's one of the dilemmas.
And the answer is always more markets or better markets rather than maybe something other than markets. Anyway, and also I think the other thing is there are lots of recommendations for different market designs out there, but they all have their flaws as well as their potential advantages. I think that's very, very clear. There's no perfect market design out there. That's the first constituency. Second constituency is the industry itself, the energy industry. And actually referring back, and this is important as well, to something we were talking about right at the beginning, I include there the BlackRocks of this world. If you drive around Sweden or Norway and you're out in the sticks in the middle of nowhere and you happen across a wind farm in Sweden or Norway, the odds are pretty good it's owned by BlackRock. Big asset managers are the major owners
one of the private equity games. Okay.
Absolutely. So their argument, the energy industry, including the asset managers, is they agree with economists. The problem is not, of course, that we're relying on markets in the private sector. Of course, that's not the problem. But they also say the problem's not the market design either. Market design's fine. The problem is that the subsidies aren't big enough. That's the argument you get from the industry. It says basically everything's hunky-dory, but governments need to come even more to the table than they already are. And actually, that's what the Inflation Reduction Act was in the US, was basically the government's response to being told by industry, look, you've been reducing the tax credits for renewables over years, and look what happens. Investment is stagnating. You need to lift those credits back up to where they were originally. So that's 100% what the Inflation Reduction Act was about, trying to lift profitability back up to the level at which investment will begin to flow again. That's the second answer. Just more subsidy, bigger subsidy.
Yep.
Third and final answer is the one that I think I'm at least most sympathetic to, which is the argument you typically hear from people on the left who would say, well, look, the private sector and markets is how we've been approaching this for 20, 25 years now. And it's still going too slowly, despite the fact that subsidies remain ubiquitous. Everywhere in the world continues to subsidize renewable energy development. And despite the fact that the cost of the technologies, the solar and the wind technologies, have come down, 40, 50, 60, 70%, it's still going too slowly. So maybe it's time that we think on a significant scale about a different approach, which would be for the public sector to take the lead. So you go back to kind of a New Deal or quote unquote Green New Deal approach.
So let's just go back. Let's just tease this out a little bit before we conclude, right? So is it the public sector in financing? So the knot here is the financing decision. And is it the public sector in doing a little bit of heavy lifting on financing? Is that where you feel that we could make some changes, and those changes could be transformative in terms of the acceleration?
Well, right now, absolutely, the public sector is involved through providing various forms of support and subsidy to the renewables industry. But it is not owning the assets that eventuate. So I think what the argument would be would that you lift the amount of financing. So the state is not so much kind of de-risking private sector investment. The state is borrowing to invest in the development of publicly owned assets, which are publicly operated, and the revenues from which accrue to the public sector. And, I have a great deal of sympathy for that argument. In theory, at least, the public sector can borrow as cheaply, if not more cheaply, than the private sector can. In theory, at least, the public sector should be willing to accept lower levels of returns than the private sector might be willing to tolerate. 4 or 5% returns, as long as no
return for a while.
Yeah. As long as it covers the cost of capital, then you would think that should be broadly sufficient. So I'm sympathetic to that argument. However, my one caveat here, and it's a very important one, I think, is that argument, I think, is much more credible in rich countries. Obviously, I would include the UKs and the islands and the rest of Europe and North America, even though they might not feel and look rich to themselves right now. They're certainly rich in terms of kind of fiscal capacities in a global government's perspective. The idea of a kind of big borrowing, big investing state in large parts of the global south where there are much more severe fiscal constraints strikes me as a little bit more far-fetched. But certainly for significant parts of the global north, I think that should be an option. And here, I don't think people are talking about kind of minor, the odd public sector renewables operator, which is what Labour's talking about in the UK. I think it would only make a difference if you were thinking about public sector ownership and investment on a significant scale, rather than kind of a bit part player in what is essentially a larger private sector.
Well, no, it's interesting for Irish people. The most significant public infrastructure that was built in the first 10 years of the state was a massive hydroelectric plant built by Siemens, but financed by the Irish state, called Ardna Crusha. And it was a very obvious example of a state saying, hold on a second, we need to do this. We have to do this. We didn't have the Black Rocks of this world back then, and we did it ourselves. And in the 1930s, which is a bizarre statistic, 86% of all Irish electricity was renewable energy. Came from hydroelectric, from that one plant, which is kind of amazing. So it is amazing. And so it has happened. So if we can sort of conclude, if you were to think, if we continue along the road here, which is kind of an half-assed private sector, subsidized public sector, it's basically, it's a dish that's trying to please everybody, right? What you're saying is if we continue this road, we will not get anywhere close to our climate change and our targets for global warming. Global warming.
That is exactly what I'm saying. And I think you're very good at kind of cutting to the chase. And I think half-assed is exactly what we have at the moment.
It's a technical term,
Very technical. We'll get there eventually, but it will be much too late and much too slow. And that's obviously a significant problem. And it will be particularly too late and too slow in those parts of the world where the greatest amount of investment is required. And here's the thing. What happens in Europe and North America increasingly is almost beside the point. It's what happens in China and India and Indonesia and Africa for two reasons. One, is those power sectors continue to be much more fossil fuel intensive on the whole than in the global north. So more remains to be done in terms of the existing systems. Second, it's in those parts of the world that the greatest incremental future growth in energy demand is likely to be concentrated. So for all sorts of different reasons, it's the necessity of decarbonizing, the work that remains to be done is disproportionately located in the global south rather than the global north. And the problem is that's where the financing challenges are greatest, because the perception of risk by private sector financiers is so much higher there.
Brett, listen, it has been great to get you on the podcast. This is basically the big question in global economics. How do you continue to expand prosperity and try and hit some climate change targets? And at the moment, what you're saying is we're kind of, to use the expression my father used to say, we're codding ourselves because of a variety of things. But the book is called The Price is Wrong, Why Capitalism Can't Save the Planet. It's Brett Christophers. Listen, Brett, that was wonderful. Thank you so much. And we'll have you back again if you'll come on.
You bet. I'd be happy to. Thanks for having me.
Mark, just before we were talking to Brett there, who was really good, we were talking about the shift in Europe and the shift in the European elections. And you were saying going from what was in the last elections a green wave and everything about the environment and climate change and all the rest to a more kind of nationalist approach.
Yeah.
So basically, based on everything that Brett was saying, like, is it time now to nationalize all our resources and our utilities?
But that would be the conclusion. I mean, I'm just saying that we've gone. Do you remember your one Greta Thunberg? Whatever happened to her?
She was arrested the other day.
Yeah, but she's kind of gone. Yeah. As things. So her age is even though she's very young, is kind of okay, whatever, right?
Yeah.
We've moved on to nationalism, etc. So those things are very much to the fore. What Brett is saying...
she's moved on to...
Palestine,
yeah.
Yeah. So what Brett is saying is, look, the way in which big infrastructural projects have been financed since the global meltdown in 2008 is there has been an outsourcing of financing to the private sector. And that private sector has been or was very, very keen to finance when interest rates were zero. But now that interest rates are 5 or maybe even go higher than that, you're not getting the same willingness on the part of those people to finance. But we still need the windmills and the turbines, and we still need it. So what he's basically saying is, you're absolutely right. There has to be the state has to take in some financing because the private sector just isn't financing them now. So it could be quite interesting. The 2020s could well be the era of the return of the big state and the return of the big financial player, because at the end of the day, the state should be able to borrow more cheaply than anybody else and should be able to put repayments on the long finger more easily because it has many, many sources of revenue. So that could be it. It could well be, John, that we are entering the era of the big state when it comes to financing climate change, because, to use a capitalist expression from Mrs. Thatcher, there is no alternative. Just let's use that against them. There is no alternative, called Tina.
There is no alternative.
Exactly. There you go. Talk to you next week.